Why rules meant to protect banks nearly broke them. Rules are written to prevent disaster. They promise order, discipline, and safety until the moment they begin to work against the system they protect. Europe believed regulation was its shield. After decades of instability, tighter rules felt like progress. More capital, more oversight, less room for error. To understand why these rules still matter today, we need to look deeper, because regulation does not just restrict behavior. It shapes incentives, strategies, and survival itself. After successive crises, European banking entered a new era. Complex frameworks replaced simpler safeguards. Risk was quantified, categorized, and standardized. Every exposure was assigned a number. On paper, this was stability. Banks held more capital. Stress tests became routine. Supervisors monitored behavior continuously. But regulation also created boundaries. Certain assets were favored. Certain strategies were discouraged. Flexibility quietly narrowed. Banks adapted quickly. They optimized within the rules. They structured balance sheets to satisfy metrics. Compliance became a competitive advantage. Over time, safety began to look the same everywhere. Institutions followed similar paths. They chased the same low-risk labels. They avoided anything that complicated ratios. This uniformity felt reassuring. Consistency signaled control. Deviation looked dangerous. Yet systems built on identical constraints respond identically under pressure. What protects one institution can strain many at once. The rules were not flawed in isolation. They were precise, logical, and well-intentioned. But they assumed stress would arrive unevenly. They assumed time would exist to adjust. When pressure came all at once, those assumptions were tested, and the safeguards designed to absorb shock began to behave like amplifiers. As regulation tightened, decision-making changed. Banks focused on ratios more than realities. Meeting thresholds mattered more than managing uncertainty. Numbers became proxies for safety. Capital rules rewarded predictability. Assets with stable histories were favored. Complex exposures were avoided. Innovation slowed under scrutiny. Stress tests reinforced these patterns. They modeled familiar scenarios. They assumed orderly reactions. They confirmed expectations already embedded in frameworks. This created confidence, but it also created blind spots. Rare events were discounted. Nonlinear reactions were ignored. When conditions shifted, constraints tightened simultaneously. Banks sought to preserve capital. They reduced lending. They sold similar assets. These responses were rational. They were also synchronized. The rules encouraged alignment, not distinction. Liquidity requirements added pressure. Holding high-quality assets was mandatory. Selling them under stress undermined ratios. What was meant to ensure resilience limited flexibility when it was needed most. Regulators adjusted carefully. Rules were interpreted with discretion. Timelines were extended, but adjustment itself signaled strain. Markets watched these signals. Flexibility was read as concern. Consistency as reassurance. Every change carried meaning beyond its intent. The system began to strain under its own safeguards, not because banks were weak, but because they were constrained in the same way. Regulation had succeeded in one sense. It made individual institutions safer, but it did not guarantee system-wide resilience. And when every institution tries to protect itself simultaneously, the system feels the pressure. The conflict sharpened as pressure persisted. Rules designed for calm markets collided with the reality of stress. Banks face impossible choices: preserve ratios or preserve relationships, hold assets or support clients, comply precisely or adapt quickly. Every option carried consequences. Selling assets weakened prices. Holding them strained capital. Lending supported economies but threatened metrics. Supervisors found themselves balancing signals. Strict enforcement risked tightening conditions. Flexibility risked undermining credibility. Consistency competed with pragmatism. Markets interpreted every move. A relaxed rule suggested fragility. A rigid stance suggested indifference. Confidence became fragile in both directions. What emerged was a paradox. The stronger the framework appeared, the harder it became to maneuver within it. Safety turned into rigidity. Protection became pressure. Uniform regulation magnified this effect. Because institutions shared constraints, their responses overlapped. Actions reinforced each other unintentionally. The system slowed. Credit transmission weakened. Economic recovery faced friction. Stability carried a visible cost. Authorities responded with calibration. Buffers were allowed to decline. Countercyclical tools were activated. Temporary relief became necessary. This kept the system functioning, but it also exposed the limits of rules. Frameworks could not anticipate every shock. Judgment could not be removed entirely. The belief that regulation alone could ensure resilience began to fade. Experience replaced theory. Adaptation replaced assumption. The system survived, but its relationship with rules changed forever. What the regulatory crisis revealed was something that technical frameworks are not designed to capture. Rules are built on models. Models are built on history. History records what happened. It does not record what almost happened but didn't, or what would happen under conditions that have not yet occurred. The gap between those three categories is where regulatory fragility lives. European banking regulation had become highly sophisticated in its historical dimension. It captured the lessons of past crises with precision. It codified the right responses to familiar scenarios. It required institutions to hold capital against risks that had materialized before, but it could not fully account for the behavior of many institutions following the same rules simultaneously, because that behavior had not produced a major systemic stress before. The synchronization that the rules created was a new risk, an emergent property of the regulatory system itself, not the intention, the outcome. And emergent properties are, by definition, not captured in the historical data that regulation is built on. When every institution simultaneously reduces a category of exposure because the rules make that category expensive, the prices of that exposure category fall. Falling prices make balance sheets that hold the exposure look weaker. Weaker balance sheets prompt further reduction. Further reduction produces further price falls. The feedback loop is not a failure of individual risk management. It is a failure of collective behavior, shaped by uniform incentives. The rules produce the incentives. The incentives produce the behavior. The behavior produced the systemic stress. And the systemic stress was the thing the rules were designed to prevent. This is not an argument against regulation. It is an argument for humility about what regulation can guarantee. No framework can fully anticipate the system-level consequences of its own rules, because those consequences emerge from how many institutions interact with a framework simultaneously, and that interaction cannot be predicted from any individual institution's perspective, or from any regulatory body's historical data. It can only be observed over time as it unfolds, which means regulation must always be supplemented by the willingness to observe, adapt, and accept uncertainty, not as a failure of rigor, but as an honest acknowledgement of the limits of any system built on the past that must function in an always uncertain future. Europe's banking system learned this more slowly than the crisis demanded, and more deeply than any subsequent calm makes visible. The relationship between rules and resilience is never as simple as more of one produces more of the other. Sometimes more rules produce more synchronization, and more synchronization under stress produces the very fragility that more rules were meant to prevent. That is not irony. That is the nature of complex systems, and understanding it is more important than any specific rule that follows from it. That understanding is not comfortable. It does not produce clean recommendations. It does not generate press releases or regulatory announcements. It produces only a kind of careful attention, a willingness to watch the system as it is actually behaving, not just as the models predict it will behave, and to adjust before the gap between the two becomes wide enough to matter all at once. That kind of attention is harder to institutionalize than any rule, but it is what the experience ultimately demanded, and what the most effective regulators, in the years that followed, quietly developed, not as a methodology, as a disposition, toward the system they were responsible for, and toward the limits of their own ability to fully understand it. Why